Thank you for joining us for our Quarter 1 2022 investment commentary. The first quarter brought with it no shortage of headlines to discuss, including the war in Ukraine with Russia, increased oil prices, inflation, higher interest rates, and market volatility. Volatility spiked this quarter with negative returns coming from all areas of the markets, as you can see in this chart here. There hasn't seemed to be a place to hide this year so far, with bond portfolios providing as much negativity to your returns as equities. Much of the negative performance from bonds has come from shifting expectations in the bond markets. Right now, we're seeing about 8 interest rate increases priced into the bond markets, and that would move short-term rates all the way up from 0.25% to over 3% by the end of next year. This has caused the yield curve to invert this year, actually briefly, which can be a sign of a coming recession. This may be a possibility, and we are watching our other parameters closely for confirmation and potential timing of this to occur. You can see in the written portion of the commentary that recession following a yield curve inversion isn't usually immediate, so there is time before this may occur. This rapid movement in the bond market, while causing some short-term additional volatility in portfolios, has also meant that bonds are now yielding much higher rates, which is something investors have been looking for a long time. One note on equity volatility we've seen this year thus far doesn't stick out as anything other than normally experienced corrections, even though the reasons for it may not feel normal. If you take a look at this chart, it shows intra-year stock market declines, the red dot in number, as well as the market's return for the full year, which is the gray bar. You can see that even though you may have drawdowns in equity markets over short time periods, they can still end the year in positive territory. To me, 2020 is one of the most drastic examples of this. You can see that during the pandemic's early days, the market was down 34% peak to trough, but ended the year up 16%. This year's roughly 13% decline, peak to trough, looks pretty average if that's all we see for this year. Inflation is, of course, still making headlines. We're starting to see some early indicators trending in the right direction for inflation, but we still haven't seen that reflected in the actual numbers. Things like inventory growth are promising, even though it might not be for cars or computers, but other items are. We are also starting to see freight costs coming down off their extreme highs earlier this year, so that's also a helpful sign.
Our investment committee has been watching the Russia-Ukraine conflict very closely and thinking about how it affects our portfolio's allocation and expectations going forward. Markets have been increasingly volatile as the conflict unfolds, but it might shock you to see the U.S. stock market is actually positive since Russia invaded Ukraine. As strange as that sounds, it is not uncommon for stocks to perform this way around global conflicts. If you attended our investment event a couple months ago, you already saw the chart we shared in this commentary's blog, but it shows stock returns after conflicts in the past and how long markets take to recover. The bottom line is, on average, not that long. The conflict between Russia and Ukraine is shaking up stock markets, commodity markets, and providing even more uncertainty to domestic inflation and monetary and fiscal policy, but there are a lot of unknowns. And during these times, diversification is more important than ever. No one knows how the future will unfold, so spreading your allocation across many asset classes is key. We'll continue to monitor these events and keep you informed as we make decisions that may or may not affect investment allocations.
To summarize, here's what happened in the first quarter. Stocks and bonds struggled because of inflationary pressures. Commodity-linked sectors and countries benefited. On the other hand, growth assets and commodity importers struggled. Lastly, stating the obvious, the war in Ukraine has had a negative impact on Europe. Now that we understand what happened, I'm sure you want to know how we're responding. First, we're monitoring our parameters to identify if or when it's necessary to adjust your bond to equity ratio. We're also using our parameters to identify when it's safe to add duration back into your portfolio. Speaking of which, our parameters are telling us short bonds are still appropriate for investors. Remember, the higher the duration, the more a bond's value will fall as interest rates rise. Consequently, we're maintaining a sleeve of your bond position in short duration investments. Second, we're taking advantage of market volatility by tax loss harvesting. Tax loss harvesting helps everyday investors minimize what they pay in capital gains taxes by offsetting the amount they have to claim as income. Finally, we routinely review portfolios and rebalance them to capture cheap buying opportunities. Thanks for watching our quarterly commentary. If you'd like to gather more insight, we'll include links to our most recent investment event and blogs. As always, we are here for you. Don't hesitate to call. Until next quarter, enjoy your spring and take care.